And if you've been watching silver, you just witnessed one of the most violent, most calculated takedowns in precious metals history. 22% in 2 hours, from $90 to $73 overnight on the Shanghai Futures Exchange. Western Spot currently sitting at 75, Western Futures at 76, Shanghai Spot 86, Shanghai Futures 90. That's a $10 premium still holding in China despite the carnage. Gold at 48.21. If you're genuinely learning and getting value from my work, make sure you're subscribed with notifications on. After that JP Morgan planned manipulation video, I received a flood of messages and comments from you saying you were unsubscribed automatically or that you're not getting notifications. That's the price of telling the truth. But Team OG won't stop. We'll keep bringing you verified news, clear data, and both sides of the story, whether it's manipulation or accumulation. We will keep bringing the truth, and we'll always tell you the whole story. No hype, no greed, no fear, no BS. Now let's get into what actually happened, because this wasn't a market, this was a war. In the last video, I told you we had no daily close above $90. I've been calling the $87 to $90 zone as major resistance for days. I'm not making this up. Go watch the previous videos, it's all documented. We tested it, we rejected it. 3 times bodies closing below that level indicated pressure and resistance building. The OG community knew it. We track the technicals. We watch the micro and the macro. We don't gamble. We plan with verified data and fundamentals. The copycats? They'll manufacture another bank crash story, another Netflix-level narrative to explain what happened after the fact. But we shared the real-time information. And if you're not following me on X, you are missing critical updates as they unfold. My handle on both X and YouTube is at OGJohnAG. It can't be duplicated. That's your verification you're listening to the source code. So what triggered this 22% overnight rejection from 90 to 73? Let me walk you through the sequence of events, because this is where it gets genuinely fascinating. On Tuesday, 3 million ounces were removed from COMEX vaults. Not a misprint, 3 million ounces. Nearly 2 million ounces withdrawn from Asahi. Over 900,000 ounces withdrawn from HSBC, another 282,000 from JP Morgan, 2.5 million ounces adjusted into Loomis registered. Total COMEX silver inventory dropped to 400 million ounces. That's a single-day drain we haven't seen in years. Physical metal is leaving the system. And here's the contradiction that should make every single person watching this sit up straight. While 3 million ounces are being pulled from COMEX, 600 more silver futures contracts were issued delivery notices in the first 4 days of February alone, all accepted for physical delivery. That's over 3,500 contracts in 4 days, 17.5 million ounces. Normally 1 to 3% of contracts settle physically. Right now, 100% physical settlement. You can't build AI data centers with paper silver. You can't manufacture missiles with paper contracts. The world is desperate for real metal. Now contrast that physical tightness with what happened overnight on the Shanghai Futures Exchange. This is, and I'm choosing my words carefully here, one of the most incredible things I believe has ever happened in the history of commodity markets in Asia. 1.4 million contracts traded on the April 2026 silver futures alone in a single morning session. That's equivalent to 674 million ounces of paper silver. Across all contracts that morning, 1.34 billion ounces traded. That's almost double the annual global silver mine production, traded in one morning. Let that sink in. This wasn't retail panic. This was a brutal, systematic short-selling attack designed to crash the Chinese silver market intentionally. But here's what didn't happen. Prices remained at a significant premium versus COMEX and LBMA. Silver remained in backwardation. The paper games aren't changing the fundamentals whatsoever. And then we get the dislocation signals that even experienced risk managers are calling unfamiliar. Spot prices down $9. London spot moved into backwardation versus COMEX. The EFP, Exchange for Physical, is signaling tightness in London even as leverage is being unwound elsewhere. Regional divergence is screaming. London is currently the best bid. China and the US are deleveraging aggressively. What does that tell you? Broad global deleveraging cycle where futures are being sold while physical metal is being absorbed. Metal leaving the US and China is largely speculative selling. Flows into London appear to be physical demand. That imbalance explains the current spread behavior. This doesn't imply an imminent price rebound. Let me be crystal clear on that. This reflects stress in a leverage-driven system. The underlying dynamic appears to be a breakdown in the neo-Keynesian financialized market structure, with behavior reverting towards spot market fundamentals. The invisible hand is no longer operating freely. It's been replaced by visible state action, regional policies, taxation, price floors, government intervention. These aren't theoretical anymore. The Shanghai Futures Exchange just announced new margin requirements for precious metals starting Monday. Daily price limits for silver futures adjusted to plus or minus 20%. Margin requirements for hedging positions up to 21%. General positions up to 22%. They're tightening the screws because the system is under stress. Now here's where this gets really interesting, and I want you to connect the dots with me. Picture this scenario. You're short silver at $70, then a government sets a price floor at $80. What happens? You're instantly underwater, not by market volatility, but by policy. There is no pullback. There's no dip to cover. Trading below $80 is no longer allowed. Your loss is locked in. $10 per ounce, $50,000 per COMEX contract. Margins are raised, liquidity disappears. You get a margin call or a forced liquidation. And here's the part that should terrify anyone playing the paper short game. If physical silver is tight and delivery is demanded, your paper short turns into a physical obligation. No metal? You pay any price or cash settle with penalties. This isn't a normal short squeeze. This is a state-backed repricing. A price floor doesn't protect short sellers. It eliminates them. You can short the paper. You can't short a floor. The moment a floor is set, the old silver market is over. Now, could that floor be set below 80? Absolutely. But if it's set too low, metal disappears. Miners don't invest. Refiners slow down. Physical supply dries up. Then the state either raises the floor quietly, buys metal directly, or subsidizes the gap. In other words, a low floor just delays reality. The real floor isn't a number. It's where silver refuses to sell. Meanwhile, CNBC anchors are mocking silver investors because silver traded above $120 and is now at $79. But silver investors are still up 150% over the past year. Bitcoin? Down 26% over the past year, and even further below its high, after erasing the entire gain it made since the election. But nobody's mocking Bitcoin holders with the same energy, are they? Let me address the resistance and bearish factors head-on because balance matters. This deleveraging is real. Speculative positions are being liquidated. Margin calls are forcing weak hands out. The environment is unfamiliar even for seasoned traders. Markets are sending conflicting signals because events are unfolding in stages. Clarity will only come once deleveraging runs its course and the dust settles. If we close below 73, 74 on a daily candle, not a prediction, just a technical level, we could see 70 and below. That's a realistic downside scenario in the short term. But, and this is critical, none of that changes the structural deficit. None of that changes the fact that 100% of COMEX contracts are settling physically. None of that changes the 3 million ounces drained in a single day. None of that changes Shanghai maintaining a $10 premium despite the overnight crash. None of that changes the fact that the LBMA benchmark snapshot was taken. Chinese shorts should now be trapped in their positions. JP Morgan likely closed billions of shorts at the bottom, and demand for physical is accelerating. The state of Wyoming just started buying physical gold and selected a private vault over JP Morgan. That's not speculation, that's official. Institutions are waking up to the reality that traditional portfolio construction, 60% equities, 40% bonds, doesn't work in this era. U.S. 10-year bonds down 50% since 2020. Gold up 3 times. Current U.S. gold holdings in portfolios, 1.4%. Imagine what happens to the price of gold if even a portion of that 40% bond allocation shifts into gold. And silver? Silver moves with gold, but with industrial demand layered on top. UBS just came out and said they believe both gold and silver can move even higher in 2026. Pullbacks this violent in a secular bull usually mark the start of the next leg up, not the end. Institutional conviction hasn't wavered. The artificially low prices created by these raids are building the conditions for a major bull market in silver because they create even more real physical demand as supply dwindles. JP Morgan was fined nearly $1 billion for manipulating precious metals markets. They paid the fine and kept doing it. Of course, the markets are rigged. That's why you take self-custody and get out of paper. In just 90 minutes, silver was systematically smashed. Anyone still leveraging silver on COMEX or trusting paper contracts and silver ETFs needs to wake up. These instruments are designed to drain retail capital, not protect it. Forced liquidations transfer real wealth to the same players every time. JP Morgan, State Street, BlackRock, via CME, the owner of COMEX. Same playbook, same outcome. Again, paper silver and physical silver are at war. Paper shorts pushed prices down 22% in 2 hours. At the same time, the physical market is being drained every day. The most telling signal is coming from COMEX settlement behavior. This is the disconnect. This is the breaking point. Now let me frame what's actually happening here in simple terms. Jesse Livermore wrote in Reminiscences of a Stock Operator that the market will do whatever it takes to prove the maximum number of people wrong. This crash just shook out everyone who was over-leveraged, everyone who bought the breakout at 90 without a plan, everyone trading on emotion instead of structure. The strong hands, they're accumulating physical at these levels. The weak hands, they just got margin called out of existence. So where do we go from here? I'm watching 3 things. 1. Can we hold 73.74 as support on a daily close? If we break below with conviction, 70 and lower is in play short term. 2. Does Shanghai Premium expand or contract from here? If it widens, that confirms the physical bid is stronger than the paper selling pressure. 3. Do COMEX registered inventories continue bleeding? Because if delivery demand stays at 100% and inventory keeps dropping, the squeeze isn't theoretical anymore. It's mathematical. The question I'm asking you in the comments, what are you expecting? 70 or below? Or can we bounce here? Not financial advice. I want to know what you're seeing in your analysis. 3 key takeaways. 1, this was a leverage unwind, not a fundamental breakdown. Physical demand indicators remain strong. 2, regional divergence is creating opportunities, but also extreme volatility. Plan accordingly. 3, the paper market structure is under stress in ways we haven't seen before. State intervention, price floors, margin hikes. These aren't normal market dynamics. Do your own due diligence. I will never ask for your money. Never pitch invest with me. Never run paid signals or funds. Protect your capital. Stay far away from scams using my name. If this added value, share it with one person who needs unfiltered truth over hype. The unresolved tension? We're watching a system transition in real time from paper-driven price discovery to physical-driven price discovery. How long that transition takes, how violent it gets, and where the floor actually settles, that's still being written. But the direction is clear. Invest with logic, not hype. OG out and about.